Welcome to another episode of Can I Retire? We bring you these videos each week to give you some ideas of how to improve your retirement and be prepared if you haven't retired yet. Hi, if we haven't met, I'm Tony Hansman with Guardian Financial, and we are a wealth management firm. We help people who are in or near retirement. And I have another hypothetical case for you I think that you're really going to enjoy. If you're worried about outliving your money, paying too much in taxes, if you're trying to get the greatest returns with the least amount of risk, then this video is absolutely for you. But stay with me to the very end because I got one thing that I bet you don't know. So behind me, I've got Ricky and Lucy hypothetical. Ricky is 62 years of age and he's going to live to age 92. Lucy is going to retire at the same time, but we're going to make her live all the way to age 94. Now I'm going to come down here and I'm going to click my next button and we're going to go over and take a look at their goals, their needs, their wants, and their wishes. And to keep this case simple and short today, I only am including their needs. They have $55,000 of what they want to live off of in retirement, and this is going to be increased with inflation every single year. But I'm going to skip out on the wants and wishes today. Wants would be if they, let's say, needed a car in 4 or 5 years, or wishes would be if they wanted to take a big family trip or some exotic place. We would add those too. So you would let us know what you wanted, we would throw those in there, and then get a probability of success of where they're at. So now let's go ahead and jump over to their asset screen and see where they're at. So now we're on Ricky and Lucy's asset page, and let's take a look. So you can see that Ricky has a 401k with about $400,000 in it. And the first couple things that I want to point out is that it's common that people work for their company for 3, 5, 7, 10 years or longer. And it's common that 401k is not being looked at on at least a yearly basis, meaning that the customer's, Ricky's portfolio tolerance is maybe completely out of whack. So maybe what he wanted 10 years ago is something completely different than what he needs today. So that's number one. The second thing is that coming upon Ricky's age, when you're nearing 60, most people can do what's called an in-service transfer, where they can take money from their current plan, move it to an independent advisor where it's being more monitored, more looked at, there's more options available to them. But be careful. We always want to make sure to do what's in your best interest. Fees could be a little bit higher, so you just want to make sure that you're reviewing that and getting all the information to make the best decision for you and your family. If you take a look, Ricky also has a Roth IRA of about $50,000. You all know that I'm a big fan of Roth IRAs. They grow tax-free. You can take withdrawals tax-free. There's no required minimum distributions on them, and there's some really neat things that you can do to leave that money to loved ones after you both pass away. So then we can see that Ricky and Lucy also have a joint account of about $100,000 as well. Total net worth or liquid assets for at least $550,000. I threw in a $300,000 house in there, so with no liabilities, puts them a net worth of $850,000. So now that you understand the case and where we're at, let's go ahead and jump over to our current scenario screen. So now we're on Ricky and Lucy's current scenario screen. And you can see behind me a button that says Run 1,000 Trials. Well, let me explain what that means. You know, most of us don't get a 5% rate of return year 1 and a 5% rate of return year 2 and a 5% rate of return year 3. It's all over the place, right? We could be up 10%, down 2% in the stock market. We could be up 8% one year, then we could be down 4%. So this is going to give us multiple sequence of returns and a good probability score to see exactly where we're at. It's going to run 1,000 different probabilities or 1,000 different trials. So if I go ahead and I hit this button, you're going to see a bunch of green lines pop up and some red ones. The green lines represent that Ricky and Lucy, they never outlived their money. But unfortunately, the red lines represent that they did. They get a score actually of 690 success scores out of 1,000 trials, or a specific score of 69%. So what does that mean? Is that good? Is that bad? If I come down here and I hit the Find Out button, you're going to see that anything below a score of 70 is a below competence zone. Too much uncertainty for their age. I really want to see them get into this green zone between 70 and 90%. But what would make me even happier is if we can get them above a 90%. It's going to give them more flexibility going into those retirement years. So now let's go ahead and jump over to their what if scenarios and see if we can't get that score up. Now we're on Ricky and Lucy's what if worksheet. You can see behind me they're currently at a score of 69. That's their current scenario. So let's see if we can make some changes in this portfolio, give you some ideas of what you can do with your own plan to get that score up. And stay with me to the very end because I'm going to give you a tip I bet you don't know. So the first thing that I want to do, believe it or not, is I want to reduce the risk they're currently taking. okay? In this example, and this is very common that I've seen, that people are taking too much risk in their portfolios. I sincerely am going to reduce the risk, which if you could imagine is going to put guardrails up around their portfolio and help limit the downside. By doing that in the retirement years, it prevents big losses that they don't need to take. By doing that, it doesn't improve the score a whole lot, but it does take them from a 69 all the way to a 72. So we're moving in the right direction. And most people like taking less risk as they're getting older. So let's make one more change to keep this video short and simple. Currently in their plan, Ricky and Lucy have thought about taking their Social Security at the age of 62, right when they retire. And that's very common. And let me be very clear. I'm not saying that they should or they shouldn't. A lot of people believe, well, I'm going to turn it on as soon as I can and start getting as much money as I possibly can back from Social Security because I feel like they're going to change the rules and whatnot. I completely understand, and I want to listen to your values, your beliefs, what you're thinking there. It's common that people will turn it on early, but I just want to show everybody all of their options so you can make the best decision when you do turn it on and help you maximize that Social Security benefit. So if we wait just a few years and turn on Social Security at their full retirement age, which would be age 67 in this particular case, versus 62, then you can see that it takes their score all the way from a 72 all the way up to an age or a score of 89%. So now we're finally really close of being in the above confidence zone. I'm feeling better, they're feeling better. And again, not everybody needs to do this, but I just wanted to let you know. Remember, taking Social Security early is a reduced amount. You're not receiving your full benefit. So we would have to dip into assets here for just those few years, then you can reduce taking money out of those assets, turn on the Social Security, and then enjoy that growth going forward. But the one thing I do want to show you, I'm going to click this button down here called Explore, and I'm going to stress test this portfolio. This is so important to understand. What this is doing is the first couple years before retirement and the first couple years in retirement, we're going to stress test this. I call it bad timing. So someone's thinking that they're going to pull assets out of their portfolio and the market's also going down. That can be really bad timing, very stressful on that portfolio. And you can see behind me here that this red line, the green line is without having those problems, and the red line is definitely if they had a couple bad years. You can see up here just in the first year if they had, let's say, a negative 21%, and then the year right after that, they had a negative 7%. That's almost a 30% loss in their portfolio, along with taking withdrawals out of those portfolios. That could be very detrimental to the overall plan. And by doing that, it just can be really bad. So what we want to do is we want to maybe have some money put aside. We want to be prepared for this. We want to have some other strategies in place so this doesn't happen to you. So my big tip today is to make sure that you're monitoring that portfolio, your overall financial plan, a couple years before you retire, and certainly a couple years after you retire. So in summary, we took Ricky and Lucy from a 69 all the way up to almost a 90%, I think it was an 89. And we want to give you a couple things to think about. You can actually reduce your risk in your portfolio and increase the probability that you won't outlive money. You need to make sure you know exactly and get with an independent advisor who can show you different ideas of when to turn on your Social Security to help maximize those dollars. And also remember, please keep in mind the importance of really monitoring those first couple years so you don't outlive that money and have big plans. So, we've got some resources for you up here. And as always, remember to consult a licensed professional who understands your specific goals and dreams.